Hi, this is John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, March 8. To view our full range of publications, visit our website at www.investingdaily.com. This week, it seems to me that the big question is, has the stock market peaked? I don't think so. Rising bond yields have slowed the post-election stock market rally, but as economic growth strengthens, stocks haven't run out of steam just yet. History does indeed show that stocks and rising interest rates don't play well together. We saw that last week as fears about inflation pushed bond yields higher and weighed on equities. But let's look at the positives. The economic recovery is accelerating. The jobs market is on the mend. The Federal Reserve won't tighten anytime soon. Jerome Powell has made that clear. And over the weekend, massive fiscal stimulus finally passed Congress. President Biden is expected to sign the $1.9 trillion package sometime this week. Also, keep in mind, interest rates remain historically low. At 1.6%, 10-year interest rates are approximately half the 3.1% average of the last 20 years. The notable change is in market leadership. I'll get to that in a minute. In the meantime, the rally slowed last week with stocks mostly closing higher, but the Nasdaq Composite swooning as tech stocks took it on the chin. Let's look at the following table. In the first employment report under the fledgling Biden administration, job growth soared in February as U.S. economic activity accelerated, with coronavirus cases dropping and vaccine rollouts fueling hopes for further easing of restrictions. The Labor Department reported Friday that non-farm payrolls surged by 379,000 jobs in February, and the unemployment rate fell to 6.2%. That beat expectations of 210,000 new jobs, and the unemployment rate holding steady from the 6.3% rate in January. See my second chart. The pandemic has worsened inequalities in the workforce as the gap between skilled and lower skilled labor gets wider. Nearly all the job gains in February stemmed from the beleaguered hospitality and leisure sector, which enjoyed an increase of 355,000 jobs amid a lifting of dining restrictions in several states. The latest employment numbers are encouraging, but there's still a ways to go before we return to pre-pandemic levels. See my third graphic. The U.S. has 9.5 million fewer jobs than this time a year ago. As of the February data, the unemployment rate is still 2.7 percentage points higher than it was before the coronavirus outbreak. Many of those lost jobs aren't coming back, which makes the $1.9 trillion stimulus package that was passed over the past weekend all the more important. But we are seeing a change of leadership in the stock market, whereby the laggards are becoming the leaders and vice versa. Overvalued technology stocks that were pegged with unrealistic valuations at the peak of the pandemic because of optimism about the work-at-home culture have fallen recently. At the same time, energy, financial, and other cyclical stocks that had taken a beating have become leaders of the pack as the economy returns to normalcy. What's the upshot? The stock market still has plenty of juice left. For details, consult my article that accompanies this video on the Investing Daily website. Well, that's it for now. If you have any questions or comments, send an email to mailbag@investingdaily.com. Stay safe and thanks for watching. See you next week.